I'm John McMahon. I'm a founder of Gore Browne Investment Management. The capital preservation portfolio is a lower risk portfolio that seeks to maintain the capital value over the medium term while still producing absolute returns which are modest but stable. There's a little bit of a story here. I was skiing in March 2008 with some friends, and a great friend of mine who is also a property entrepreneur was talking to me on the chairlift as we went up the mountain and explaining that he had a lot of his company's money with Icelandic banks in order to get the slightly higher interest rate that they were offering at that time. This was several months before the financial crisis really broke, but I knew enough about what was happening in the sector to tell him that it wasn't a good place to have your money. And he listened to me, and he moved his money out of the Icelandic banks well before the crisis really hit them hard in autumn of 2008. He really appreciated what I'd done, and as a result of that, he asked me to create a new low-risk portfolio, and that's how the capital preservation portfolio came into existence.
Hi, my name's Tom Hewitt. I work at Gore Browne Investment Management as an investment manager. So the capital preservation portfolio can be used as a standalone portfolio strategy or combined with a growth portfolio. But the key thing about this is that the client or individual investing in the capital preservation can take comfort that they know what the capital preservation portfolio is doing with certainty, with a lower level of risk, which enables them to explore greater levels of investment risk elsewhere should they wish to do so. At the same time, we have clients who have a growth portfolio and a capital preservation portfolio, or it can just be on a standalone basis. Clients in the past may have had money sitting within a bank account where they're getting no real return, and this enables them to achieve that in a lower risk way compared to investing in the market. The main difference between a capital preservation portfolio and a traditional portfolio is really around the volatility management and the diversification. So a traditional portfolio will be built with diversification in mind, but the capital preservation portfolio will be doing that, but then at the same time focusing on volatility, so looking how to reduce the volatility. And that can be done by comparing the different assets, looking at seeing how they are correlated between each other. So if one goes up, does the other one go down? And it's trying to get a balance, so not everything goes up at once and not everything goes down at once.
It's for virtually anybody because it's lower risk. It doesn't have the constraints that high-risk investment would normally carry with it. It's popular with a variety of people, for example, who really don't like the volatility of equity markets, but also people who more recently see the returns on their cash deposits as having fallen substantially to zero or even negative. The modest returns, but at least stable returns, which the portfolio produces, are attractive to them too.
So the dynamic between John and I feel is very good. We're both ex-bankers, so we are on the whole more cautious, but we like to challenge each other, and we have a different sort of age difference between the two of us, which is great, and so we have different experiences. We will constantly look at new areas in terms of what's happening within the portfolio. An example of this is that since the start of the creation of the capital preservation portfolio, it's been mainly centered around bonds. Now, with the rates of return available on bonds at the moment very low due to the very low yields, we're having a good debate about at the moment, should we be changing this? We have a good discussion. Decision making will be done on a consensual basis.